Good morning. I trust you can all hear me loud and clear. Um, yeah, so if you can hear me loud and clear, please just give me a wave. Give me a wave on the screen, so I know that you can hear me. So if you can hear me loud and clear, yes, yes, yes. Okay. All right, Sharif. Okay. So I can see that very loud and clear. So thank you for accepting our invitation to be part of this webinar today on the new tax amendment for 2023 and what you need to consider in your 2024 tax planning strategies in view of this amendment. My name is Amos Edu. I'm your host and the moderator for today's webinar. And I have a lady and two gentlemen here to help with the discussion. But before I go ahead or ask or introduce my panelists, let me just give a brief intro or background to this subject for discussion. In April 2023, the government of Ghana passed 3 new acts that significantly altered the tax landscape in Ghana. And these acts or amendments were the Excise Duty Amendment Act 2023, that is the Act 1093. And then we have the Growth and Sustainability Levy Act 2023, that is the Act 1095. And we have the Income Tax Act 2023, that is the Act 1094. So these acts have been very topical, and they have, generated a lot of arguments, if you like. So as taxpayers, what do we need to know about this amendment and how it affects our business? And what can we do as we go into 2024 tax year? What are the things that we need to consider in our strategy? So this and few others are what we will be discussing today on our webinar. Let's observe some ground rules for this webinar. To stop any feedback, we have muted all your microphones to prevent feedback. And if you have any questions, please note them down, or you can put them in the Q&A box, and we will attend to all questions at the end of the session. So feel free and be part of this. We want you to be part of this discussion from the onset. So just make sure that you have your questions and comments ready in the question and answer chat box. All right, so as I indicated earlier, I have a lady and a gentleman, two gentlemen here from our tax department here at SCG, Chartered Accountants. So I would introduce them, and then we can start the discussion. So the first, ladies first. So I'll start with my lady. We have Esla Odami on the panel. Esla is an assistant manager of the tax unit. Esla has been with SCG for over 8 years, and she's very experienced in handling tax issues, both for local and international clients across different sectors of business. So Esla, you are welcome.
Thank you, Amos.
All right. So the next is Philip. Philip is senior associate, also with the tax unit. Philip has been with SCG for over 4 years now, and he's also quite experienced in handling tax issues involving both local and international clients. He's been involved with GRA tax audits extensively. So Philip is also here to help in discussing this matter. So Philip, you are also welcome.
Yeah, thank you for having me.
All right, so I go to my senior colleague, Collins. Collins is a very experienced tax and audit professional. He has been in the accounting profession for over 35 years, and currently he is the tax partner of the SCG Chartered Accountants. So Collins is also here on the panel today to help us to understand some of these acts and its implication. So Collins, you are welcome.
Thank you very much, Enimo, for having me.
All right, so thank you, ladies and gentlemen, for accepting to be here, and also our audience, thank you for joining us. All right, so before I start with the discussion, let me just pull this post up. Let's understand how knowledgeable we are about the new tax amendment. So if you can see my screen, I have shared a post with you. Just go ahead and then share your answers. Let's know what you know about the new tax. Okay. Yeah. So yeah. So just few seconds. Let's pull this one. Okay. All right. So I can see a lot of voting going on here. Yes, I will share the post result with you. So just don't worry. Yes, it's going on. Okay. Okay. So we have just some 5 seconds to end the poll. Okay, so thank you. Let me share the results of the poll so we know. Okay, so this is how it looks. Knowledge of the new tax amendments. Are you aware of the new tax amendment? That's the question. So yes, about 43% say they are aware. 26 are not aware. 30 are aware but not sure of the details. All right. Do you understand the requirements of the new tax amendments? 17 do not completely understand the tax requirements. 43 are not even aware of the requirements. Wow. And 39 are aware but not sure of the details. So, ladies and gentlemen, this gives us something to consider as we go ahead with our discussion. So thank you very much for participating in this post. So we can go ahead now with our discussion. All right, so I'll start with you, Ursula. Thank you for participating in this post. So we can go ahead now with our discussion. All right, so I'll start with you, Ursula. All right, so Ursula, it's been 6 months now since the passing of these laws. How has it been implemented so far? Can you give us an overview and how it's been implemented so far from a tax professional's point of view?
Yes, thank you, Amos. Yes, as you rightly mentioned, there has been a significant number of amendments that has been passed, and these amendments have actually been one of the topical issues, since April this year. And these changes are actually affecting both individuals and then companies. We've received some guidelines, regarding the clarity on how it's been applied, but then we are also expecting more of the guidelines. So before we discuss in detail on the implications, of these amendments, I'll give an overview of these amendments. So the first one I'll talk about the Excise Duty Amendment Act. That's the Act 1093. And with that, there's actually been an increase in the excise duty that's been charged on specific goods produced both locally and then imported into the country. An example that I'll give is cigarettes and tobacco products. You have more drinks all being affected, and even mineral water. So mineral water, that was 17.5% of the ex-factory price, is now 20%. So this is actually going to cause an increase in the prices of these products. Secondly, I'll talk about the Income Tax Amendment Act. That's the Act 1094. That's the big one, where there were lots of changes, provisions in there. And for individuals, the most significant measures that I'll talk about is the PIT, the revision of the personal income tax bands. So there's been an introduction of, an additional income band of 35% for taxpayers with an annual income exceeding 600,000. That's 50,000 monthly. So here the government is actually targeting high earners. But then it will also benefit those, below the threshold, since, you have the minimum wage also being increased by about 400 cedis. And then secondly, I'll talk about the employer provided vehicle benefits. That's also another one for the individuals. So here essentially there's been an increase in the upper limits that is placed on quantification of benefits for PIT purposes. So generally, this will actually result in an increase in the chargeable income for individuals who are enjoying these benefits. So if you're enjoying, for example, vehicle with fuel, now the cap has been increased from 500 per month to 1,250 per month. So with that, we'll talk more about that on the implication, but just giving an overview. And then the changes to the taxation of gains on disposal of investment assets. So with respect to that, previously individuals had the option to pay % respect to the disposal of assets. Okay, but then now what is happening is that now that optional rate of 50%, and now they're also required to file a return, reporting such gains within 30 days. And then lastly, on the individuals, the changes affecting the individuals is the withdrawals from Provident Fund or the personal pension scheme. That's also an exemption, the waiver there for those who would want to do withdrawals, from the pension schemes. But then there are conditions, regarding that you need to meet before, that exemption will be granted. And then on the companies, first is the minimum chargeable income regime. So in there, what you have is that, for the amendments, now companies making losses consistently over 5-year period are now required to pay 5% on their turnover. That's a huge one. We'll talk more about that. And then I will talk about the unification of losses regarding carry forward of tax losses. So with that, there is no more priority or non-priority sectors, when it comes to carry forward of losses. All companies, get to enjoy the 5-year carry forward of losses, and that's a good news. There's also restriction on deduction of foreign exchange losses. So here the amendment is actually limiting the deduction of foreign exchange losses to only realized losses. And even the realized losses, it excludes transactions, between residents and capital losses. So if there are any unrealized losses, you cannot be granted a deduction. You also have the taxation of, temporary concessions, where those under the concessionary rates have been increased from 1% to 5%. And then another topical one is the taxation of lottery operations, where my partner will talk more about it. So basically, the tax on lottery operations are now being based on their gross gaming revenue and not profits. And a tax of 20% is applied to it. So I'll move on to the last amendment that we'll talk about before Philip comes in, will be the Growth and Sustainability Levy. So that's now applicable to all companies. It's just that they've been categorized, into the various sectors. So when you go to the GSL now, they have been categorized into A, B, or C. So this amendment is actually phasing out. Initially, we had the National Fiscal Stabilization Levy, which is now the GSL. And in there, so category A, you have banks, non-financial institutions. They are required to pay 5% of their profit before tax, as levies. You have those within the B, that's the mining companies, and those in the upstream also falling within the category B, and all other companies are required to pay 2.5% of their profit before tax. So it's actually widening the scope, of the initial National Fiscal Stabilization Levy that we had. So I'll let Philip, give us a bit more detail about some of these changes in the income tax, and then Collins will also talk more about the taxation on lotteries. Yeah.
Okay, Ursula, thank you. As you rightly said, I think Philip will come in. There's a touch on the minimum chargeable income and other restriction on deductibility of exchange losses. So Philip, kindly take over and help us understand some of these things, the amendments that have been passed.
Yes, thank you. I think Ursula touched a bit on it. The minimum chargeable income was inserted into the income tax amendment. We saw the introduction of the minimum chargeable income, where the GRA may require an individual or a company to pay a minimum chargeable income of 5% on their turnover, where the person has recorded losses in the previous 5 years of operation. However, this law does not apply to companies that have just commenced operations, and also companies or individuals that are engaged in farming. Now, this is interesting because ordinarily, if you make a tax loss, you are not liable to pay tax in that relevant year of assessment. But with the introduction of this minimum chargeable income, is that you may make tax losses, but then the tax law may also require you to pay a minimum fee, a minimum tax on the loss that you made in the year. And I think this goes in a way.
So in effect, there's in the face of the taxman, or in this amendment, there's no loss.
There's no loss.
Okay.
That is it.
Okay.
There's no loss. So if you are a business, you may be encouraged to make profits in the relevant years of assessment, because 5% on your turnover may exceed the tax you would have paid if you had declared profits in that relevant year. Yeah, so moving on to the foreign restriction on the deductibility of foreign exchange losses. We can see this income tax amendment extended the provisions under Section 25. Now we've seen the insertion of Section 4, subsection 4 to subsection 7. Now, you see, foreign exchange loss deductibility was already controversial, but with this new amendment, it gets a lot more controversial, because previously, exchange loss, whether realized or unrealized, was an allowable deduction.
Yeah.
And exchange gain and unrealized exchange gains are also included in arriving at your chargeable income. Before even these losses are subject to the finance cost limitation. But what Section 25, the provision in Section 25 does is that, one, it restricts you from deducting unrealized exchange losses. Two, if you've had transactions between resident entities and there's a foreign exchange loss as a result of that dealing, that is also disallowed. And now, exchange losses of capital nature are not allowed a deduction. You may be granted capital allowance on that. So I think what this does to the taxpayer is that, one, if previously you were declaring tax loss as a result of being able to deduct your unrealized foreign exchange loss. With this new amendment, you may not be able to do so. So this would greatly affect companies that are into imports, because usually companies that are into high imports, they will incur a considerable amount of exchange losses.
Okay.
And some of them may not be realized in that particular period. So what this amendment is doing is that if you were in a tax loss position, with this amendment, it may turn you into a chargeable income position, and there you'll be required to pay tax.
To pay taxes.
To pay taxes.
This is interesting.
This is very interesting. It's
And
very
I
interesting.
think maybe this also puts some sort of measures in place for managers of businesses to be more prudent in their approach to business, so they don't run into losses, possibly.
Yes, exactly. But I think there'll be hedging methods that you can use, or you may ensure that you realize all your exchange losses, so that even then it will be subject to the finance cost limitation. So even if you realize all your exchange losses, you are not out of the woods yet.
Sure.
You still have to meet the finance cost limitation.
Thank you, Philip. I think you've explained it very well for us. And before I go to Collins, Collins, I will be asking him to touch on the very interesting aspect, which is the taxation on lottery operations. This is affecting a lot, and it has brought about a lot of debates and arguments in the gaming space, i.e. the betting, the lottery, and all the other gaming, activities that are being done across country. But just before Collins comes in, I would like to remind you that if you have any question or you want to make any contribution or comments, please feel free and put them in the chat box or in the Q&A box, and then we would attend to these questions at the end of the session. The panelists would be more than happy to address all the questions that would come up. So, Collins, there is also an amendment on the taxation of lottery operations, which is saying that now lottery operators or gaming industries will be charged 20% upfront on their gross revenue. How does this play out in the face of the amendments?
Thank you very much, Amos. I think this amendment, like you mentioned, has brought a lot of debate and discussion and agitation in country. I think the law make provision for two specific issues. The law introduces a 10% withholding tax on winnings. And then the law also introduced a provision that affects companies that operate in the gaming industry. What we've observed is that continent-wide, it looks like revenue administrators have identified the gaming industry as a growth pool or a sector to rake in revenue for government. So across the continent, a number of countries are going along that tangent of taxing companies in the gaming industry. So fundamentally, if you look at the countries or the continent, countries like Kenya, countries like Tanzania, countries like Rwanda, they've all introduced various measures to tax both winnings as well as companies in the gaming industry. Ghana has followed suit, and Ghana in this amendment introduced a 10% withholding tax on gaming winnings, and also moved away from the renowned and known principle on which tax is based. Hitherto, companies are taxed on their profits, and all companies being taxed on their profits, Section 9 of the Income Tax Act, Act 896, requires that before you determine the profit of an entity, you should allow the entity expenses that have been incurred wholly, exclusively, and necessarily in deriving the revenue. This principle is now being completely ignored. Gaming companies in the gaming industry are now being taxed on their gross gaming revenue at a rate of 20%. And that is a significant departure from the principles that we know about taxation. Like I said, other countries are following similar modules. Tanzania is going along the Ghana route, for example. The question I keep asking is, in terms of sustainability, how can companies that incur expenses, how can they continue to operate and be sustained and grow in the mid to long term if you completely disregard the expenses that have been incurred wholly, exclusively, and necessarily in deriving that business? And for me, it doesn't look a sustainable strategy. Short term, you may rake in revenue, but mid to long term, if you want to grow that industry, I don't think it's a sustainable strategy. And that is the area I really, really want us moving forward as a country to look at it that close again. Indeed, some companies have already started indicating measures to either fold up the operations or do things as a result of this new law that had been introduced. Rwanda, in my view, Rwanda is the model that I think still keeps the fundamental tax principle. Rwanda, for example, taxes gross gaming revenue on a monthly basis at 13%. Okay? And then at the end of the year, Rwanda taxes corporate income tax at 30%. So at the end of the year, Rwanda allows you the expenses that have been wholly, exclusively, and necessarily incurred in running the business. It takes that into consideration. Assess your operations at the 30%, and whatever payments have been done during the course of the year, a reconciliation is done, and either you are credited or you paid any difference. So it creates room that, yes, revenue continue to gather revenue or its cash flow on a monthly basis throughout the year. But at the end of the year, the right thing is done and a reconciliation is done. But when we completely ignore expenses that are incurred wholly and exclusively, I don't think it's a sustainable strategy going forward.
Thank you, Collins. I think that's an interesting subject, and hopefully maybe the government or the GRA would come up one day with the rationale behind this, amendments, having to ignore the basic principles of taxation and not taxing it's upfront on the gross revenue. So I am not sure whether it is to encourage participation in the gaming industry or to kill interest in the gaming industry. But I don't know if you want to share an opinion there.
Well, what I've observed that there are two schools of thought. If you listen to the debate in the public space, there are two schools of thought. One school of thought says that, look, gaming is not an industry that should be encouraged and get the youth into it. And therefore, if you follow that line of argument, in my view, the law will definitely cease to kill the industry. Yeah. But the other school of thought is that if you want it to be an industry that you want to develop and sustain and grow, I don't think the strategy is going to be successful going forward.
Thank you, Collins. Philip wants to add something. Philip.
Yes, Amos, I just wanted to indicate that we recently also saw the passing of the practice notes on the taxation of lottery operations. But what we've noticed or realized is that in terms of withholding on winnings, what is currently being implemented is not in line with the practice notes that were issued. I think the GRA, first off, should have engaged gaming operators to estimate the time that they will need to properly configure their systems to be able to pull out whatever data that the GRA would require, and also to be able to tax as stated in the practice notes. So currently, I think we are looking at a makeshift implementation of the withholding on winnings and not in line with the practice note. I think what we are looking for is that the GRA may come out either to instruct gaming operators to comply with what is in the practice note, or they may probably have to amend how the withholding on winnings is being implemented currently.
Okay. Thank you. So I'm still reminding our participants that if you have any question, please feel free. Let's have your questions come in, or your suggestions or comments or anything that you want to talk about regarding this discussion, and then we would attend to them at the end of the session. So, Philip, we would talk about our tax, how this whole amendment is going to affect the taxpayer in the 2024 tax planning. Is very important because the amendment brings a new set of challenge and requirements on taxpayers, and therefore certain things must be considered as we go along, or as we go into planning for the year. So let me just ask you, when we talk of tax planning, in the first place, what is it? And then what should the taxpayer consider going into 2024?
Right. Yeah, I think tax planning on the whole is for you to take advantage of any tax relief, avoid late filing penalties, and then thereby you increase your tax savings by taking advantage of tax reliefs. Also, it's you identifying the possible complex transactions for the year, and then trying to comply with the requirements of those transactions. And so I think in short, that's how I'll put tax planning.
Okay. So which tax type are we looking at when getting into the 2024 planning?
I think the amendment touches on quite a number of tax types, but for the purpose of this webinar, would limit it to the employment tax, corporate income tax, and then transfer pricing.
Okay.
Yes, so we'll be looking at the monthly PAYE under the employment taxes. We'll look at the annual PAYE return that you are required to file. And we also look at the annual employer deduction schedule. And then finally, we'll look at the personal income tax return under the employment tax. For corporate income tax, we'll look at the company self-assessment, the corporate income tax final. And then for transfer pricing, we'll look at the annual transfer price and return, and then the transfer pricing documentation filing.
All right. So you mentioned the employment. You mentioned the employment tax. Ursula, what is it? What is expected of taxpayers, and in view of this amendment, what is the expectation?
Okay, so for the employment taxes, there's a requirement for both the employer and then the employee or the individual. Okay, so for employers, the first one I'll talk about is the monthly PAYE. That's the pay as you earn. So employers are required to withhold an amount from their taxes from the employees' remuneration, at the end of the month, and then file on their behalf. So apart from the monthly PAYE returns, at the end of the year, so 4 months after the end of the year, they're also required to file an annual PAYE return, which actually gives a summary of all the PAYE deductions in various categories of the employees, rather than individual employees, and then attach the annual employer deduction schedule. to the return and filed. So that's also required 4 months after the end of the year. They are required to file these returns with the tax authorities. And failure to do that attracts a penalty of 500 Ghana cedi plus 10 cedis each day. So you should know that if you don't file these returns, there are, sanctions regarding that for the employer. And then the employee or the individual, that's where the PIT return comes in place. So for individuals, especially for directors, they are supposed to file their PIT, their personal income tax return. So with that, individuals are required to file this return, declaring all their income in. So for residents, individuals, so you are required to declare your income from employment, business, or investments, for the year. And that also, failure to do that also attracts penalties. And with the personal income tax return for the individuals, you need to consider, apart from the salaries, your income that you earn, you also need to consider tax release. There are also tax release for marriage, for child, age dependency. So there are lots of considerations that you need to take in place, when you are computing your personal income tax return for the year. So with regards to the, implications relating this to the changes that we've discussed earlier, with regards to the amendments, what do you need to look out for, within this amendment? So we made mention of the tax band, the changes in the tax band, and then the motor vehicle benefits, which came into effect May 2023. So we realized that from January to April, you would have computed the PAY taxes based on the previous tax band. And we find the new tax band having a higher, percentage. That's where you have the extra 5% increase in the taxes, in the rates. So what you need to do is, when computing your annual taxes for the PIT, you need to consider both bands, both the graduated rates applicable for January to April and then for May to December. Because if you decide to use just the current rates for all the period, you may end up having either an underpayment or overpayment of taxes. Because, for instance, for the motor vehicle benefits, in the case previously, the limit was around, if you take vehicle with fuel, for instance, you had a benefit where you are only being taxed on an amount of 500 Ghana cedis on a monthly basis. Now, the limit has been increased to 1,250. So in the instance where you are now going to be taxed on a higher amount, you realize that your chargeable income at the end of the year will be higher than what you were paying previously. So you need to consider these two bands in order to get, and especially use the monthly rates to be able to get the actual tax that you're required to pay for the year and file with the tax authorities, right? So that's also one key thing you need to be looking out for when preparing the personal income tax return and filing as such.
Okay. Thank you, Ursula, for that one. So before I move on to my next question, so let's confirm that if essentially the timing deadlines have not changed, basically. So taxpayers should be mindful of that. There hasn't been changes in the filing timelines.
No. So
Okay.
for the filing timelines, it still remains. So for PAY, you're supposed to file the 15th month, the 15th day of the next month.
Of the next month, okay.
And then for the annual returns, that's where you're supposed to file 4 months after the end of the month.
Okay.
So those remain the same.
The same, okay.
What is changing is actually the bands that you need to consider, graduated rates. So
Okay.
you need to know where you fall and take considerations of all the new bands in there.
Okay.
Yeah.
All right. Thank you. So now, Philip, corporate income tax is a principal element in companies' overall tax exposure for the year. Okay. So companies cannot do without filing their corporate income tax. So what are the requirements as far as corporate income tax is concerned, and also how does it affect reporting? How does the amendment affect reporting this time around?
Right. Under corporate income tax filing requirements, there are two key things that comes up. One is the company self-assessment, and then two will be the corporate income tax final. So for every tax year, revenue requires you to file an estimate of the tax you expect to pay. So for the company self-assessment, you are required to file and pay your corporate income tax in 4 equal installments. The first installment not being later than 3 months after the year end. That is first 3 months into the relevant period of assessment. Now, what you should do to ensure that you comply would be to, 1, prepare a budget. You make a meaningful estimate. It is very important with this new amendment. Now, your meaningful estimate or your budget should include the balance sheet, your statement of profit and loss, your cash flow, your fixed asset addition, and the details of the expenses you anticipate to incur. Now, this budget should be used to estimate the quarterly tax payable. So I think with this new amendment, we saw the implementation of these new amendments earlier in June, where we saw the implementation of the Growth and Sustainability Levy. So in June, when companies were filing for their estimates, they were required to also file alongside the estimates the Growth and Sustainability Levy that they estimate to pay. Now, this is charged on your profit before tax or your gross production, depending on which category you find yourself. So now it's not just about estimating the tax you think you should pay or you think you would pay, but it's also estimating the levy that you'll be liable to. And so that is why I'm stressing on preparing a budget and a meaningful estimate, because this shouldn't be the time where you just off the cuff of your head you come up with a figure. Oh, we'll pay 20,000, but in actual fact, are you also liable to pay the Growth and Sustainability Levy Act?
There has to be some basis for
yes
the amount you pay,
yes
or you intend to pay.
Yes,
yeah.
exactly. And the tax law also affords you the right to revise these estimates as you see fit, or as the year progresses and the reality on the ground reflects. And so for every quarter, you can revise your estimates, whether you anticipate to pay a lot more taxes or you anticipate to pay less taxes than you estimated in the first quarter. Now, there's a caveat here. What the government has done to protect, I would say, their interest, or to protect receiving revenue on time, to use them for developmental projects. There's a provision that if you estimate and your estimate is less than 90% of the corporate income tax that you actually paid at the end of a relevant period, the revenue will charge an interest on that shortfall, that 10% shortfall. And these interests will also be compounded on month-by-month basis. That is 125% of the statutory rate applicable. And then this will be compounded monthly. So it is in the best interest of taxpayers to ensure that whatever estimate that they are making is meaningful and is a bit realistic. That's why you have the opportunity to revise these estimates as you see fit. Yes. So, okay, we'll speak on the corporate income tax final. I think this is also very critical because here everything comes to play. Here you've been able to finalize the figures, your financial statements, you've been able to reconcile and close your books. And so your tax position would be final. That's why the final is there. So here you are required to file a corporate income tax return at the end of the relevant year of assessment. So here you ensure that you file the returns 4 months after the end of the relevant period. So for companies with the January to December year end, by April, you should have filed your corporate income tax return. Well, I mean, there may be issues or reasons why you may not be able to meet the April 30th deadline. And so the tax law also affords you the opportunity to extend the due date for filing the return. Once your application is submitted within or before the due date, the tax law would afford you extra 60 days to be able to complete that return, the corporate income tax return filing. Now, in light of these amendments, what I think you should be looking out for is probably before 2023 began, companies were not in the position to properly plan their taxes. And so once these amendments were passed, they were already halfway through the year. The amendments were accented in April, so they were already halfway through the year. And so it probably would have been difficult to plan their taxes accordingly. And I think it was also important that these amendments took effect for 2023 year of assessment, because we saw the issue in 2022 where the revenue, the foreign exchange was fluctuating. The CD weakened against the US dollar, and as a result, I think a lot of companies incurred exchange losses, and some were realized, some were not realized. And so, in effect, I think it was very timely on revenue to ensure that these laws took effect in 2023. Otherwise, a lot of companies would have been found wanting. In that regard, it is important to plan your taxes for 2024. Ensure that you have timelines to be able to settle any foreign exchange losses, any foreign exchange transactions that you be engaged in, to fully realize these exchange losses. And then they'll be subject to the finance cost limitation. We've also seen the introduction of the harmonization of unrelieved losses. Now, previously, they were segregated into a priority sector and non-priority sector. The priority sector had the opportunity to extend or carry forward their unrelieved losses for up to 5 years. But with the harmonization, every other company can now carry forward their tax laws for up to 5 years. And so you can also take advantage of this new amendment. I mean, it's not all increasing chargeable income, but this also affords you the opportunity to reduce your chargeable income. Now, like Collins mentioned earlier, now gaming companies will not be taxed the conventional way. Yes, and so at the end of the relevant period, you'll be required to file a return that details your total gross gaming revenue that you filed for the year, an annual return on the gross gaming revenue that you filed for the year. And so those things should be taken note of, and then taxpayers should also plan accordingly and ensure that they have detailed expenses when they're estimating their taxes, and also take note of how these new amendments affect their tax position. Because previously, if you were able to deduct and realize exchange losses, now you cannot do so. So probably if you expected to pay less taxes, you should reconsider your tax position again, and then make the necessary provisions for that.
All right, Philip, thank you. I think let me just, before you come back, okay, to complete, and then I will then get into transfer pricing also with you. But I've already seen people, some participants sending in questions already, very interesting ones. So if you also have questions, please feel free and let them come in. Would address those questions as we go along. Philip, thanks for lightening us on some of the requirements with regards to this new legislation for 2024 tax year. Do you want to still add something, or I can ask my next question of the, okay. Finally, transfer pricing filing is also an important part of corporate filing for companies in controlled relationship. Okay, how does the new amendment affect transfer pricing, and what should taxpayers also expect or consider in their planning for 2024.
Right. So I think for transfer pricing, what we saw this new amendment do is expound more on what a controlled relationship is. I think that is what was included. There was a substitution for section 128 in the Income Tax Act. So what I feel this does is that it brings a lot more light on transfer pricing, because over the years you've seen companies be very negligent of that obligation or tax filing requirements. I think in other jurisdictions, the penalties imposed for failing to comply with transfer pricing requirements is much steep than as compared to Ghana. I mean, Ghana is still 500 cedis plus 10 cedis each day. These returns remain unfiled. But in other jurisdictions,
that's the penalty.
That is the penalty. And so you see clients weigh the cost against the tax exposure if they fail to comply. And so that is what I think this amendment seeks to bring. And we've also seen a more aggressive posture from the GRA in terms of conducting transfer pricing audits now. They've equipped their transfer pricing unit to be able to enforce these provisions in the transfer pricing regulation. And so the filing of annual transfer pricing return was a requirement, I think, since 2023. But with the promulgation of the LI 2412, it brought into focus the transfer pricing documentation requirement. So for transfer pricing, what we'll talk about will be the annual transfer pricing return and then the transfer pricing documentation filing requirement. So for the annual transfer pricing return, you are to disclose to the tax authorities any related party arrangements that you engaged in during the year of assessment. You disclose the nature of these related party arrangements, be it stock, be it revenue, be it raw materials, be it management fees, be it loans. And also you are to disclose the transfer pricing method that you used in determining the pricing for these transactions. And so, like the corporate income tax, 4 months after the year end, you are required to file your annual transfer pricing requirement.
Before I go on to our questions, Collins, you want to add something?
Is that the moment you have a group or you operate in a group, some years back, we had a number of companies that were in groups. They had various divisions within the group, and they transacted among themselves. The fundamental principles or transfer price is that whatever arrangements you have should be at arm's length. And what is arm's length? Arm's length means that if you are in a group and you sell a product, maybe at a price of 20,000 Ghana cedis, that price should be the same price that you should sell to an independent person that is not within the group. So the moment you deviate from this practice, the tax authorities will come in and say, no, these transactions were not an arm's length. And like Philip had said, we've seen quite huge penalties being slapped on companies following transfer pricing audits. So even though the penalties for non-compliance of these requirements is low, 500 cedis for non-compliance and 10 cedis for each day that the lapse continues, in the event that there is a transfer pricing audit and transactions are rearranged and reclassified, it could expose you to huge penalties that you've not planned. And therefore, it's absolutely important that you have this backup, which will serve as a defense mechanism in the event that there was a transfer pricing audit, and you can then defend whatever arrangement that exist within the groups.
All right, thank you, Collins, for that addition. Now let's start with our question. Let's start with our question. I don't know who will take this, but Inusa Garuba wants to find out. I don't know who will take it. Is Tesla or? But let me just pose the question. He said, what happens when your estimated tax payable is more than the actual tax payable at the end of the year? Okay, who would want to take it? Okay, Ursula.
Yeah, so obviously that will lead to an overpayment, the tax at the end of the year or tax credits. And with the overpayment, you can carry it forward to subsequent years, subject to a GRA audit, because until an audit has been conducted, okay, to confirm this overpayment, you can only have it within the corporate income tax, returns. You cannot use the tax against other taxes, okay, such as withholding tax or PAYE. No, it only falls within the corporate income tax return. So you can carry forward this overpayments subject to a GRA audit.
All right, thank you. Then from the same, from Garba himself again, what happens if a company files a nil returns for 5 years continuously? What is the best option for the company?
Is it a nil returns where the company is not active, a dormant company, or a nil returns where the company is making tax losses?
Okay, Garba, it looks like the question is not very clear. So if you can type the question so it can help us to address it better for you.
I think what I can say to that is that a new return, like Philip mentioned, is when the company is dormant, and you don't want to wind up the company, or you not made a determination to wind up the company, so you continue to file a return in the hope that you reactivate the operations of the company. Yeah.
I think in the perspective that Collins has taken it, then you should notify the GRA of the dormancy of the company before you are subject to any taxes.
So in effect, if the company is running losses, it's as though we should know whether it is active or not active.
Yes.
And if it's not active, then GRA must be notified.
Yes.
Why the company is dormant.
Yes, exactly.
Okay, that is why it is posing losses for this period in question.
Yes.
Is that correct?
Yes.
Okay,
correct.
So thank you. I think, Garba, that answers your question. If you are not too clear about that, you can come back with further extension or explanation to your question. This one is coming from, okay, Derek. He said, with regards to the assessment of lottery operators, will there still be an eventual final corporate income tax at the end of the year of assessment, taking into account total revenue and expenses, or GGR tax is regarded as final tax in respect of these entities? Colin, who do you want to take it? Philip.
Yes.
Okay.
So
I hope you got the question.
Yes.
Okay.
I think I got the question, but Collins mentioned earlier how the Rwanda approach is. That is where at the end of the year they take into consideration the expenses and then compare the tax payable against the GTRs that you've paid. But with respect to Ghana and our current tax law, the GGR is your final tax.
Okay.
That's why I was advocating that this practice, in my mind, is not sustainable, and it deviates from the fundamental tax principle that we know. And my recommendation is that we should go back to best practice of allowing companies at the end of the year, assessing them at the end of the year, just like we assess all companies. Why are the companies in the gaming industry being treated separately? I don't understand. I think the Rwanda practice is a best practice that we should emulate going forward.
Right. Also, in addition, there can be negative GGR, where there can be negative GGR where your pains is more than what was staked. Your payout is more than what was staked, and so in that regard, you can carry forward that negative GGR to offset a positive GGR. So that I think that is a way of making it more fair.
Okay, all right. Thank you, Philip. Esla, I think you will take this one. He said, this one is coming from an anonymous attendee. He said, are NGOs required to file CIT? If yes, is there a threshold of revenue to be taxed?
Okay, yes. So for NGOs, okay, the Act specifically exempts, incomes derived by NGOs from tax. And, the main sources of their income is mostly donations, grants, and endowments, basically. But then the exemption does not cover business income, from these NGOs in respect of, so when you talk about disposal of assets, sale of goods, operations of a bookshop, sometimes they have these income, aside their main core mandates, and with those incomes, those are subject to tax. So irrespective of their operations, as to whether they are in the main line of operations where they are getting donations or they have business income, they are supposed to file their CIT return. Okay, at the end of so 4 months after the end of the year, they are required to file the return and pay tax on the business income, because that is where the exemption does not cover. So when you're making income from such business, for that one, you need to declare and pay the tax on it.
Yeah.
Yes. So for them, yes, they are required to register with the GRA, file their returns, withhold, on payments to suppliers. They're also obliged to, comply with the CIT requirements. Yeah.
Yes, and in addition, I think when ESLA is saying register with the GRA, it is notifying the GRA that you're an NGO. So you apply to the GRA as a charitable organization, and when they approve, that is when you will not be subject to corporate income tax. So it is not per your own discretion that you file to the GRA as an NGO. You would have to apply to the GRA.
Somebody must authorize that status for you. You can't take it upon yourself unilaterally.
Exactly.
Is that correct?
Exactly.
Okay. All right. That's great. So there's another question here from another anonymous. I don't know why you are not adding your names, but let's run through. It said, please, does the G&S, that is the Growth and Sustainability Levy, take effect in 2023? If yes, how is it supposed to be paid? Quarterly or one-off? What happens if you have not paid any as of October 2023, assuming it is to be paid quarterly? Please, did you get a question?
Yes. Okay. Yes, I think in my earlier submission, I stated that the GSL levy, the GSL Act was implemented, or the implementation began in June 2023. That is the second quarter for January to December year end. So companies were required to, when filing their estimate for the year, also estimate the growth and sustainability levy that they anticipate to pay. And this is also paid quarterly, every quarter. So like I mentioned, if your budget shows that you have a profit before tax, and then based on the category you find yourself, whether category A or B or C, you compute the GSL payable and then make the payment every quarter. Yes, and so as of June, taxpayers were required to make the payment as if the GSL was already in effect from the first quarter. So if you anticipated that the levy, the GSL levy you would have paid for the year is 10,000 cedis based on your profits before tax. As of June 2023, you were expected to pay 5,000 cedis as a GSL levy.
Thank you, Philip. Thank you all for asking those questions and making those comments. If you still have them, fine, you can still send them to us. Even if we are not able to address them here, we can address them later on via our website and social media handles through our content that we share with you. This webinar is being recorded, and we will share this on our YouTube channel, so you have the benefit of listening to it again on our YouTube channel and through our website as well. So that is it. Now, ladies and gentlemen, I would like to take your final comments on this so we can wrap up the discussion for today. So I would like to start with Ursula, as usual, ladies first.
Yes.
So what are your final comments?
Yes, so I would say that, even though we are still in economic crisis, the GRE is conducting a lot of audits, with the aim of raking in more revenue for the government. So areas where previous audits overlooked, you should bear in mind that going forward, 2024, they're actually going to be strict, attention to some of these areas. So our advice, our clients and our audience, to ensure that they actually comply with these laws, and more importantly, actually consult, their tax advisors in areas where they are not sure on how to apply some of these laws or these changes. Yeah, so that's what I have to say.
I think this is very important, because sometimes we may assume we know what to do, and then we just hit a nag along the way. But if you have any difficulty, I think it's the best thing to do is to talk to your tax experts, who have the capacity to advise you well, so you get out of those kind of problems in future. So thank you, Ursula, for that closing remark from your side. Philip?
Yes, yes. So in my closing remark, yes, like Ursula said, it is important to be abreast, one, with this new tax amendments, and to also take a very proactive approach towards managing your taxes. Possibly consult an advisor, look at the possible tax risk areas, and then try and come up with tax effective ways of dealing or complying with some complex transactions. And like Ursula also mentioned, we've seen a more aggressive approach from the GRA in terms of local tax compliance, customs, and also transfer pricing. So it is in your best interest as a taxpayer to ensure that your affairs are in order.
Thank you, Philip. So Collins, your closing remark?
The remark is not directly related to tax, but I think what I will recommend, especially for the local companies, is that you got to maintain adequate records, because all the issues that will come up in terms of taxation is dependent on what records you've maintained. And if you have appropriate and good records, one of the key challenges of meeting your tax obligations would have been resolved. If you don't have adequate records, then you open yourself to a lot of challenges when tax compliance issues come in. So my advice is really go back to basics, maintain adequate accounting records, and have evidence, because at the end of the day, the name of the game is evidence. When there's a tax audit, you've got to demonstrate that indeed the expenditure you incurred is backed by adequate records, is been reflected in your books, and that is where the accounting and tax issues will start. So please maintain adequate accounting records. It's absolutely critical and important.
Maintain good accounting record. These are very important and critical to your success at going through any tax audit. So thank you, ladies and gentlemen, for that, very insightful discussion on the new tax amendments and what taxpayers should expect or should consider going into 2024 tax planning year. For those of you who made the time to join us, we are grateful, and we really, really appreciate your time for joining us, and we hope that it's been very, very helpful to you. If you still have any question, feel free. You can send us email on at info@scg.com.gh, and this discussion will also be posted on our YouTube channel and website, www.scg.com.gh. We have a lot of content there that addresses some of the questions you might have even not asked. We have already addressed them, and some of them that you may have but could not be discussed on this platform, you still have answers there. So thank you very much for joining us, and we expect you, or we encourage you to join us again in our subsequent webinar. Have a great day and enjoy your business time.